Hello, welcome back to my YouTube channel, Accounting for the Win by Yukta Sharma. I am Yukta Sharma. I'm a qualified CMA US and I'm a CPA aspirant, and I'm here to help you with some accounting concepts. So, there was a quick intro again because of my new video kind of a setup. So, let's start with today's topic, which is equity method of accounting for investments. So, now we always start with a general rule. What is the general rule here? When you own 0 to 20% of voting interest in a company, you use the fair value method. When you own 20 to 50%, you use the equity method. And when you're owning more than 50% in a company, you have to consolidate. Now, the fair value method and consolidation is a story for some other day. Let's focus on equity method. So what did I just tell you? 20 to 50% of voting interest, you use equity method. And that is also called as having significant influence over the investee company. So the company that we're investing in is the investee company and we are investor because we are investing. Okay. So now there are two exceptions for this 20 to 50% voting interest. Now, the first exception is that even if you own 20 to 50%, there can be a case where you don't have significant influence on the company. So in that case, you would not use equity method. Uh, the other situation is that when you're owning less than 20% of voting stock, you're owning, let's say, 15% of voting stock, but you still have significant influence over the company, then you would use equity method. Okay. What is this significant influence that I'm talking about? The general meaning of this is that when I invest in a company, I am maybe not the boss of all decision making, but I still have significant power with me, significant influence. Without me, decisions are not made. I am contributing to all important decisions of that company. That is the general meaning of significant influence. Now, from an exam point of view, let's jump directly to the journal entries. Um, so, your first entry should be initial investment. Now, naturally, because investment is an asset, it's increasing, we're debiting it. Cash is an asset, it's decreasing when we're paying cash to buy an investment, we're crediting it, investment to cash. The second entry is to record net income or loss of the investee company in your books. Now, the net income or loss will increase or decrease your investment. In case they have profit, that will increase the value of my investment. In case they have loss, that will decrease the value of my investment. This journal entry is with the point of view of a profit. Let's say they earn a profit, I will increase my investment account with that share, and I will also go to equity in earnings. Equity in earnings is an income statement account. Okay. Next is dividend received. When they declare dividend for us, usually what do you do when you receive dividend income? Cash to dividend income. But here in equity method, you're supposed to debit cash but reduce your investment account. You're supposed to reduce the investment. So that those are the journal entries. Let's go to our first example here. Now, on January 1, 2025, company A buys 30% of company B for 100K. Now, this is the cost, this is the value, initial value of my investment. So, in my first journal entry, I'll record investment in B to cash of 100K. Okay. Now, second point, during 2025, company B reports net income of 50,000. Now, they have an overall net income of 50,000. How much share do I own? 30%. So, what is my share of net income there? 50,000 into 30%. So, that will be 15,000. So, I'm going to increase my investment and credit equity in earnings. Next is dividend. They have declared $10,000 of dividend. So what is my share in that? 30%. 10,000 into 30% is 3,000. So cash, I have received cash to investment, which I'm reducing because of dividend. Okay. Now, what is the value of this investment at the end of the year? So at beginning it was 100K. I've added net income share of 15,000 and I have reduced 3,000 of dividend. So that should come down to 1,12,000 of net investment at the end of the year. Okay. So that was equity method of investments. I hope I was able to add value. I hope this video helped. Um, Please subscribe for more such videos and stay tuned.